Liquidity. All right. So some of you may remember this diagram from the start of the technical analysis module. And I'm not going to go on a big rant about this, but essentially this is where I was trying to preach to you that my belief is market structure is king, or at least with the way that we trade. It's what you need to nail first. You need to have a very, very good understanding of it, because that is the bare bones skeleton of our framework, of our strategy. And we need to have that completely solid first. We build that solid foundation. And then everything else, all of the other concepts, we kind of layer on top and we go from there. So, whenever I'm looking at a chart, whether it's a blank chart or whatever, the very, very, very first thing I'm doing is thinking about structure, right? I'm mapping from the higher time frames, my swing high, my swing low, then the internal, then the fractal, whatever, right? And you work your way down the time frame. So you're always starting with structure. Once you have your structural ranges in place, then what do you do next? Then you add in those supply and demand zones, right? Within the current swing range. And that's what we've added in next, okay? So hopefully by now, okay, you don't have to have those mastered, but hopefully you've got a somewhat decent grasp of both structure and then how we integrate supply and demand onto and within our structure. And now obviously what we're going to be looking at, right, is liquidity. So liquidity, it can be a concept that can, again, probably be a little bit overwhelming, particularly when you go into it. You can get a little bit lost in the sauce with this. It can get a bit technical at times. It can be a bit subjective at times, depending on sort of how you view it and how you use it. The theory behind some of it can get a bit wishy-washy. So I'm going to try and do my best to kind of add in layer by layer by layer, and we'll build it up. And then hopefully by the end, my goal is to, because this is what my goal is with my own trading, is to introduce it in a way that is as mechanical as possible, so we know exactly why we're using it and how we're using it, to essentially just improve our edge that bit more. And kind of the main way in which we use liquidity is to help us refine the POIs, so those supply and demand zones we're trading from, and that's pretty much it. So it's knowing, it's just another filter, right? It helps us to know which supply and demand zone to trade from and what to look and wait for with our entry models when price is there. Okay. Once we then nailed all three of those, then we'll start to again really dive deep into those entries and then eventually management. Okay. But this is the order in which we need to have sort of those things, learn. And again, I'll just end it on this. Whenever you have your price chart and you're not sure where to start, or you've got lost, just delete everything, start with the structure, know what range you're in, add in your supply and demand, then use your liquidity concepts to refine those POIs and to know what you want to wait for when price gets there. Liquidity concepts will help with that. And of course, that then leads you into your entries. And then once you're entered, then you can think about management, right? That's the order in which we do things. So liquidity is essentially, like I said, it's a concept that can get a little bit, unnecessarily overcomplicated. So we're going to try and keep it somewhat simple for our purposes in the market, okay? When we start to talk about what it is, why it is, and how it happens, we're going to keep it somewhat simple to just, have a theory to hold on to, okay? So market liquidity is essentially the amount of demand and supply there is in a market. So it's like the amount of orders, the amount of volume. And the most simple way to think about it is how much money is there at every price level. There's a lot of money at every price level. There's tons of people wanting to trade at every price level. Then there's a lot of liquidity, right? So another definition is the ease to which a market can be bought and sold without affecting its price. So what that essentially means is if a market is very liquid, then buying and selling activity, it's not going to have much of an impact on price movement, right? Because price volatility will be very low because there's people trading at every single level. So it's going to take a lot of money to move price a lot because there's people wanting to buy at every price level, right? So then if you think about the opposite case, which would be a illiquid market, so that's the opposite of liquid, illiquid, this means there is low liquidity. So then buying and selling activity, trading, it will have a much higher impact on the movement of price, right? So price volatility is going to be a lot higher when it's an illiquid market because there's not a lot of people trading at each price level. So price has to move a far distance to find where the next buyer or seller is, right? So that's what you'll see in illiquid markets like penny stocks, or if any of you have traded altcoins and crypto, some of the really low market cap coins, they will move a lot when big orders are placed in the market. Even the housing market to some degree is pretty illiquid. So the diagram here, this illustrates what liquidity looks like in terms of an order book in the market. Okay, so each of those lines, each of the red line and the green lines, they represent a price level in the market. So you can even think of each of those lines as being a pip. So like 1.112, 1.113, etc., etc. So if a market is very liquid, like it is on the left, then there will be bids and offers at every price level, but also there will be a large amount of volume at each of those levels. So you can see that by the money there, right? 5 million at each price level. So it's a massive amount of supply and demand at each price level. That's what a very liquid market would look like. So if you've ever clicked buy or sell with a market order on, say, euro dollar via your broker, so you just click buy and it will get you in the market straight away, you will pretty much instantly get filled at that current level. And the reason why is because it's an extremely liquid market. There will pretty much always be enough liquidity on the other side of your order to instantly fill your trade, right? Especially if you're a retail trader and you're not trading tens and tens of millions, you're pretty much going to get filled straight away on a very liquid instrument like euro dollar. However, with illiquid markets on the right-hand side, there may not be any bids or offers at certain price levels, and or the quantity, so the amount of volume of supply and demand at each of those levels might be a lot lower too. So that diagram on the right, you can see some of those gray dotted lines just to show that there's no volume at that price level. There's no one with an order there. No one wants to sell or buy at those gray dotted lines. And you can see the numbers, so 500,000 is a lot lower than 5 million, right? So there's a lot less supply and demand in that market. So like I was saying, a typical example of an illiquid market would be the housing market, right? So if you put your house up for sale, there's not going to instantly be someone immediately outside your front door ready to buy with your exact asking amount in cash, right? That doesn't happen. Whereas in the FX market or in a liquid market, when you click sell, generally there's going to be an instant buy and you get matched straight away. So in the FX market, if there was illiquid market conditions, this is where you will often see price gapping and moving aggressively to fill the next best available order. So this is kind of a key thing to think about. For every buy order in the market to be filled, there must be, it must be matched with an equivalent sell order, and vice versa. For every sell order in the market to be filled, it must be matched with an equivalent buy order for a trade to occur. So that sentence is super important for you to understand the concept of inducement, which we're going to look at later in this module. So I'm going to repeat that sentence. For every buy order, there must be an equivalent sell order for a trade to take place. And for every sell order, there must be an equivalent buy order for a trade to take place. Okay? Because otherwise no trade can take place. If you want to buy at, say, the price was $2 and you want to buy at $2, if no one's selling at $2, then how can you buy it? There's no one to sell to you. So if you're buying and there's no one at $2, then there might be a seller at $2.20, and that's where you're going to have to go up and buy, okay? So if there's no seller, then you can't have a buyer until you both agree on a price, right? Pretty basic stuff, but this will help you to really understand some of the concepts later, because that some people kind of sometimes struggle to get your head around. So this diagram shows an illiquid market. So remember, each line represents a price level in the market, and at each price level, there is an amount of resting orders, so resting liquidity ready to be filled. So if you were trading this illiquid market and you placed a market buy order of $700,000, right? So you're entering the market at the current market price. And remember, when we buy at the ask price. Okay, so we have to buy at the ask, and that ask is the first red line there. We cross the spread and we have to buy at the ask. But if we are looking to buy $700,000 of whatever instrument this is, but there's only $500,000 at the current ask price level, what do you think is going to happen? Well, if you press buy for 700,000, you would instantly absorb all of the liquidity at that nearest ask price, and price would continue to shoot up another 5 price points until all of your demand had been absorbed by the available supply in the market. Because you're buying $700,000 worth of this asset, but there was only $500,000 worth of volume being sold at that current price. So you instantly get filled 500,000 at that price level that you wanted, but to fill the remaining $200,000 worth of your order, price has to keep moving up and up and up and up, right? Until it finds that remaining $200,000 worth of orders. And that's where we end up there at the top of that price level. So price is constantly seeking liquidity to rebalance price. So when we see those large imbalances between supply and demand in the market, remember this is what we've been doing the whole way through the supply and demand module, where we've been looking at those zones on our price chart so far. That's what's happening, right? we are viewing this process on the order book via the price action, via candlesticks. Because when prices move by that imbalance between supply and demand, it will then keep moving to seek liquidity to then rebalance price at what it deems to be a fair value. So that's why you see the market move impulsively in one direction, whilst it seeks that liquidity to rebalance price. And then you see the market move correctively. It moves sideways until another imbalance is created, right? When those large orders step into the market that then break price out of that range, and then price starts rapidly moving to another direction. And then what is it doing? It's seeking more liquidity, more orders, more money in the market until it's rebalanced again, until supply and demand kind of even each other out for a little while, right? And then we'll see that corrective sideways movement whilst the market deems it to be at fair value. That is the heartbeat of the market. So the aim of the game that we are playing by using technical analysis is essentially using all of these concepts as a mechanical framework to read what is happening on that order book. But we don't have an order book, right? So how do we do it? We do it with the price action on our candlestick charts, okay? So again, we're using technical analysis tools, the tools that we use to try and read what that order book might look like, but we're just doing it with our candlestick charts. So we spent ages looking at market structure. And what is the purpose of using market structure? Well, we use it to help us with direction. So whether price is bullish or bearish. We use it to see if we are trading with or against the trend. And then how that all fits together within the multi-time frame story, right? When we build that higher time frame narrative from the daily, the 4 hour, the M15, et cetera, how that all pieces together. We also use market structure to see how well something is priced within the range, right? So we use premium and discount. Then we looked at how we can use supply and demand zones. And what does this do? This shows us where potentially large orders have entered the market, because that's where we see price causing those huge imbalances that rapidly shift price to make it move in one direction. And therefore, when we draw those zones on, that signals that potentially there may be some orders left sitting there. So then we can use that to our advantage when price returns to those zones, right? So a simple way to think about supply and demand zones, it's just to think about where did big money step into the market, right? We're looking for those footprints of institutional money on the chart. And that's what those supply and demand zones show, where those big imbalances in price occurred. So now the next tool we're going to be adding to our arsenal of weapons is to help us identify where large pools of orders may be sitting in the market and where price may gravitate and move towards. And that's using liquidity concepts, okay? So we're going to hop on the chart, so it'll be a bit easier to visualize. But if you literally think of that supply and demand zone, right, the way we looked at it, price is ranging, and then price breaks out of it to the upside and starts rapidly moving in one direction. What that is doing is it's then searching for where the next level of supply and demand is going to be, right? Where those pools of orders are going to be, and liquidity concepts are a way in which we're going to be able to sort of anticipate that, okay? So liquidity in the market, you can kind of think about it as acting as a magnet for price to be attracted to, okay? It will start moving in the direction of where the next big pool of liquidity is going to be, because after those huge shifts in supply and demand that have caused those imbalances in the market, price is then constantly seeking the next available liquidity pool to tap into all of those orders to rebalance price, right? To make supply and demand more equal again. It kind of helps to think about it that way. And then it will tap into that liquidity pool, and that will provide the fuel for the next market move in whatever direction that's going to be, okay? So identifying liquidity in the market, it can obviously be a very useful tool for us to use in our analysis. But if we're not looking directly at that order book, right, that we just looked at, then how can we spot where there is liquidity lying in the market on our price charts? So that's what we're going to look at next to kind of see, how we can hypothesize where those resting pools are going to be.